Yes.
Okay, so good morning, everyone, and thank you very much for joining us. My name is Jimmy Chakacha. I work for the International Finance Corporation as a SME banking consultant. I support this project and other Banking on Women project and other SME project. And today I am really honored to be your moderator for the session. I'll be supporting Esther, who is the main trainer of the session today. And we have a great session lined up for you. And just to give a brief introduction about IFC, IFC is a short form for the International Finance Corporation. It is the private sector arm of the World Bank Group. And on this end, we have partnered with Cooperative Bank of Kenya, which is one of the financial institutions in Kenya, to be able to build the capacity of SME clients, SME and business owners like you through this financial literacy program. So today, we will be looking at understanding financial statements. And like I've said, we have a great session lined up for you. We are going to use examples. We are going to have polls. And just to let you know that your microphones have been muted and videos turned off, just to ensure that we have a very good communication and a flow of the training. So we will be using the chat box to really communicate. So put in your comments, your questions, and your submissions in the chat box. For those of us who have questions, there's a Q&A session there, section. Please put it there, and my colleagues will be try as much as possible to speak to them and to answer them as the session goes along. So without much ado, I'd like to hand it over to Peter from the Corp Bank side, business banking, to just give us some introductory remarks, and then Peter will hand it over to Esther, who is the main trainer for today, and we will take it away. Otherwise, thank you very much. Sit back, relax. Thank you very much for sending in your expectations, and we hope that you're going to have a very good session. Over to you, Peter.
Thank you so much, Jimmy, for those welcome remarks. And thank you, our customers, for joining this webinar. And before we start, and as a tradition for the bank, we will start with a word of prayer. We'll have Immaculate Nanga, who is a relationship manager in business banking department, and also a subject matter expert supporting on collections. She's part of us, and she will be praying for us before we proceed. Over to you, Ludi. You can hear me. Thank you.
Good morning, everyone. And thank you, Peter. Welcome, everyone. And let's bow for a word of prayer. Our dear Father, we come before you this morning. Come before you, Lord, this day. We thank you, Lord, for the gift of life, for the gift of each and every member present here, all our customers throughout the country. We thank you, Lord, for them. We thank you, Lord, for their businesses, and we pray, Lord, even as we go through the training, the understanding financial statements, that, Lord, may you open up our minds, may you help us, Lord, so that we are able to grasp, we are able to learn every single thing that is going to better our businesses, oh Father. We thank you and we glorify your name, because you are our God, Father, you are our guide, Lord, and we don't take it for granted. For this and many others, dear Father, we pray and thank you. Amen.
Thank you so much, Immaculate, for that prayer. And our customers, we want to take this opportunity to welcome you in this MSME webinar. This is part of the program that, as a bank, we have introduced to continue empowering ourselves with skills that are very, very key to help us survive and grow our businesses. And as we indicated in the last session, we have done this. We'll have more than 50 sessions that we have continued to have, and we continue to receive the feedback from you in regards to the topics that you want, and we continue to work on the same to ensure that then we address these, because they are needs that you need to have as you continue to do your businesses. So we are glad that you joined us, and you've also joined us in good time. We're also glad that you've been participating in all our sessions. We appreciate we appreciate so much. And as we continue in this particular one, we want to believe that we'll have a very engaging session as we have had in the past. And we'll be having Esther Masharia, who will be taking us through this session. She took us through the business records last week, and I think we will continue now. We'll be taking from where she left, and she will now go to the part of understanding the financial statements, because this is very key for us, even as we do business. We want to understand what is this statements that we talk about. How do we really interrogate them, and we really learn them, so that even as we come to the bank, then we are clear what is this that we are also presenting to the bank, and what does the bank look for even when we're looking for financing. So we will have a series of additional 8 sessions that will be related to this, supported by IFC, and I'm very sure we'll be able to learn. So at this juncture, I want to invite Esther to take it up and proceed with the presentation. Over to you, Esther.
Thank you very much, Peter, for that introduction. And thank you, Jimmy, for ushering us into this session. Would like to welcome you to this session on understanding financial statement. This is a follow-up on the session we had on business records. We are offering you this skills building course because we know that you have challenges in understanding financial statement. And this course is going to equip you with skills that are going to help you to value the financial statement and to just see what they really represent in making decisions. So understanding of financial statement, it's just like a treasure hunt game where you get into those statements. There is so much treasure that is in it, and it is only if you're able to get all the clues that are inside there that you'll be able to be guided in making the decisions. So when you take time to understand the financial statement, you're going to discover what other business owners may probably bypass when they are not looking for them, because you can only get a treasure if you're looking for it. So the course will help you to find all these clues that are usually there in financial statements that lead to a deeper understanding of your journey in the success of your business. The efforts in the treasure hunt in your financial statement is going to yield rewards for you. And at the end of the course, you're going to know more about the financial statement and the help that they can offer you. So before we start this course, let us answer a fundamental question. What challenges could you be facing in understanding financial statement? What challenges do you have in the understanding of financial statement? When you're using financial statement, what challenges do you face? And we have a poll that Jimmy has put up. Let's take 2 minutes to fill in that poll.
Okay, so thank you very much, Esther. I've put up the poll and we are asking, what challenges do you face in understanding financial statements? All right, so I see your responses have started coming in. Thank you for that. It's going to be up for 1 minute. We are 30 seconds away. All right. And people are still joining. Thank you for those who are joining us. Ian from Kiambu, Matinde, David from Nairobi. You're well right on time, so very much welcome there. Grace from Kibra. Okay, so we have 10 seconds remaining, and I'll bring this one to an end, and then we will share and see what challenges we have for us to be able to understand financial statements. Okay, there you go, 4 seconds. And we end. So Esther, let me share the results.
Yes,
and we
please.
See how we have fared. All right, so 39% are saying, I don't understand the difference between the statements, and 11% are saying, I don't know what the component means. I don't produce financial statements often. 30% are saying that. And then 14% of us are saying, I don't know how to use them. And then 5% are saying, I think they are more useful to outsiders, for example, the bank, than for me. So over to you, Esther, and that's how it looks.
Okay, thank you. Thank you for those responses. And as you can see, most business owners, they do not understand the financial statement. And at the end of the day, there are those who think that these financial statements are not really for me. They belong to somebody outside the organization. So let us see what benefits this course is going to bring to us. So this course will help you to know if your business is making a profit or not. It will also help you to assess the financial strength of your business and also improve your business decisions. And also it will also help you to identify financial information of interest to you and others outside the business. And with that, let us look at the key objectives of this course. After this course, you'll be able to describe the key financial statement. There are usually 3 key financial statements, you'll be able to describe them. For each of the financial statements, we are going to look at the definition, the importance, and also the format. So you'll be able to know, to explain the importance of the financial statement and also to explain the format of the financial statement. Before we move on, let us agree on some ground rules. We request for all of us to participate. Let us participate. The more you participate, the more you learn. And also, let us respect each other. We respect all views and opinions expressed, so do not be afraid to bring them on board. The microphones have been muted so that you can be able to hear the speaker clearly, and also we eliminate any background noise. So these are our 3 rules, very simple. So so in case you have a question, put it in the Q&A. And for any kind of communication, let's do it on chat. Do not raise your hand, just put it on chat. So let us immediately go into our first session. And we need to define financial statement. In our chat box, in your own words, how would you define a financial statement? Let's get to the chat box, and in your own words, how would you define a financial statement? We have 2 minutes for this. Yes. In your own words, how would you define a financial statement? Our answers, we are putting them on chat.
Let's see what we have.
Wycliffe, please put your answer on the chat box.
Okay, someone saying any information showing me how my business is going, transactions in and out. Okay, and the responses are coming in very fast here. Let me just sample some and read them out. Okay, so we have records showing day-to-day financial operations of a business. Another one says a financial statement is a document that shows you how money flows in and out of your account. And then let me sample one last one here. Says Juliana says it's a statement showing the performance of your business. Wow, and the list goes on. So over to you, Esther.
Thank you, Jimmy, and thank you for your participation. That is a good trial. Now let us formally define financial statement. Very good trials over there. So financial statements, it's a collection of summary level reports about the organization's financial results and financial position. When you're talking about a collection, it implies that there is more than just one report. So that this is just a correction, and also we summarize at this level. So what we are implying in this case is that a summary of the accounting information that we pulled from the business records. And it is important to have a very strong bookkeeping system because it is the backbone or the bedrock of the financial reports, as we saw in our last training last week. It consists of more than one statement. That is our financial statement. And in order to get the complete picture of the financial performance of your business, you need more than one financial statement. And all the financial statements, they're important because they provide crucial and different but related information about the business, and none of them can be ignored. All the financial statements, they are supported by the accounting information that is gathered from our business activities. And we are going to look and see how this works. Okay, so we have the financial decisions that are supported by accounting information. And these are some of the accounting information that we have. What are our current assets? We have the tax balances, accounts payable, we have the cash in and cash out. What capital do we have? These are some of the accounting information that we have as we have displayed on the screen. Okay, so when we have a very well organized bookkeeping system, which is vital for our business of operations, it is going to be very critical in the success of the kind of financial statement that we end up producing and in our control of our finances. So as we are looking at that, not only should you know how your business is performing financially, but also you should understand why. The why is really going to help you in making decisions. And in that, we are going to move and see what are the key financial statements. And my first question in this is, can you be able to list any of them? Can we list the key financial statements that we have? The major financial statement.
Okay.
Okay, I hope
Income
you're
statement
getting
is
some.
one of it. Thank you so much, Hassan, for that. Profit and loss. That's
Profit
Lydia
and loss.
and Mary. Balance sheet. We have cash flow statement. Wow.
Wow,
Thank you very much.
Great.
Yeah.
That is great. And I can already say we are far ahead.
Mm-hmm.
The major financial statements we have the profit and loss statement, we have the balance sheet, and we have the cash flow statement. Okay, those are the key financial statements that we have. And now we are going to begin our treasure hunt. These three statements have a lot of treasures that are in there. At first, we are going to learn about the profit and loss statement. This is a very good place for us to start, and we start by defining the profit and loss statement. So, the profit and loss statement, it summarizes the trading activities of a business over a period of time. Over a period of time. For example, we can say it is the profit and loss statement for the year ended 2020. It's for the whole year from January 2020 to December 2020. When we are talking about the trading activities, this is what we do, the buying and selling, either of our products or our services. So that is what we talk about, the trading activities. We can also say that the profit and loss statement can actually be likened to watching a video from the beginning to the end. How we started, beginning of the year, and all the way how we are going towards the close of the year. So in the same way, the video is going to contain key characters. The profit and loss usually contain three key components. And the components that we find there, we are going to find income in the profit and loss. This is the money earned. We also get the expenses, the cost of running the business. And eventually, we are able to get the profit, which is the financial reward that we get. And we are going to take a closer look at each of these three elements, one by one. And let's start with the income. And as we start off, let us list the business income that we usually get in our businesses. What are the examples of business income that you get in your business? Where do you get your income from? Let's go to our chart.
So we have sales. Okay.
Yes,
sales is
sales.
taking the lead here. Services, sales, offering services. Okay, so sales is taking the lead as far as business income is concerned. Rental income, IT services, investment. There's one saying a loan, commissions, debt payment, tuition fee, and the list goes on. So I'll hand it over back to you, Esther.
Thank you very much. That is great participation, and we see that. So those are great sources of income, and we can add some more. To begin with, we have the sales income that comes from our trading. Then we also have rental income that also has been given as an example. This is the income that is raised when you rent out your business, your properties. Then we have interest income. You keep money in the bank and in the savings account or fixed deposit. The income that comes from it associated with the business, we factor it as interest income. Then we have dividend income. Your company buys shares in another company. You get some dividends. That is where you get your dividend income. We also have the gains on sale of assets or other investments. You get to a certain level, there are some assets in your business that you need to dispose, and you dispose them at a profit, then that also is part of business income. What I need to put across is that a loan is not an income. A loan is not an income. It is money that you borrow to help you to earn income. A loan will come with a specific purpose. It is either purchasing an asset, it is going towards adding of stock. And now from that stock, you can be able to get an income. So a loan is not an income. You must pay back all the principal, and you pay it even with an interest portion into it. It is a positive cash flow into the business, okay, but it is not an income. What I would urge you to do is that pay special attention to the sales income, because this income is generated from the core activities of your business. And hence, it is the one that sustains the business. It will help you get the property to get the rental income. Get enough money to save so that you can get interest income. Get enough money to invest so you can get dividend income. It is the core of your business. And the business must be selling products and services for it to get the sales income. Otherwise, it is going to close down. All the other incomes are supplementary to the sales income. Okay, so as the income is flowing into your business, costs are incurred. And in that case, what I would like us to do is that what costs do you incur? What expenses do you incur in your business? What are the business expenses that you experience every day? Let's go 2 minutes into our charts. And let's see the expenses that you incur in the business.
Okay, one of it is salary. Another one saying buying materials. All right, transport, rent, utilities, communication, salaries. All these fall under business expenses.
Wow.
Purchases, salaries, airtime. All right, so I'll hand it over to you, Esther.
Thank you. Thank you for those responses. Thank you, Jimmy, for taking us through. And what you can see is that there are various expenses, and this is great. We need to know how to classify the expenses. So let's classify our expenses. The expenses They are classified in various ways. And these are the cost of running the business. We have what we call operating costs. Under operating cost, we get the direct cost or production cost, and also we get the indirect cost or the overheads. And also we have the non-operating expenses. The direct cost or production cost, they are the costs that can be traced directly and fully to the production of goods and services that we offer. Indirect costs, or what we call the overheads, they are the day-to-day running costs of a business. They go beyond the production of the goods and services. The non-operating costs, they are the costs not related to the core operations of the business. And examples of each of these categories, we are going to see it later. So let us now go ahead and get some examples of some of your business expenses that we call the operating expenses. Okay. So we have got the direct cost. The direct cost. What are the direct costs in your business? Do you have any direct costs? Examples of the direct costs. And especially if you're in manufacturing. Even those in retail, do we have some examples of the direct costs?
So we have one here, buying materials,
Buying materials,
electricity,
thank you.
fuel trucks,
Yes.
purchases, internet costs, raw materials, cash to buy goods and transport. Okay, so over to you, Esther.
Thank you very much. So we see we have got manufacturing materials. Any materials that you're buying, they go at a direct cost. That's what you're going to see. Then we have production wages. For those people who are in that factory, who are producing the goods or the service, that is the wages that you pay to them, that is direct. Then we have direct purchases. You buy goods directly to be sold into the shop. Then those are some of the direct costs. Then you have direct labor. That factory manager or that person who is so fully involved in the production of the goods and service, the labor that you pay. We have fuel and power consumption. If you are not producing that item, that fuel and power would not have been used. That is a direct cost. Then we go ahead and look at the indirect expenses. These are what we call the overheads. And the overheads, mostly you find they are grouped into three, what we are calling SGA, GA. And let me tell you what this is. We have selling costs. These are salaries from the sales personnel, travel to market, the marketing cost, and the distribution cost. That is what our S stands for. Then we have general costs, the rent that you pay, the office supplies, you're talking about all the stationaries, the airtime, the utilities, and the insurance. All these are our general costs. Then we have administrative cost. The administrative cost, you are looking at the salary of you probably as the CEO, your PA, your administrative personnel. Then the legal, you at one point you consult a lawyer or even you have a lawyer in your company. That is also an administrative cost. The other is accounting. What you pay your auditors or the accountant, those are administrative costs. Then we also have the excuse me a bit. Apologies for that. We have the non-operating expenses. So, under the non-operating expenses, we have interest or the financing costs. We also have foreign exchange risk, losses that come about if you're trading across the border. We have loss on sale of assets. You sell an asset and you make a loss, then that comes at the loss on sale of assets. Then we have restructuring expenses. If there are some changes you're doing in your business and restructuring comes on board, then that also comes at the non-operating expenses. We have lawsuit settlements. You are taken to court and you need to pay some money. Then those expenses you incur definitely are at the non-operating. They are not concerned with their trading. Okay? And after we look at all this, your reward of doing business is a profit. And so we are going to go ahead and look at the profit. And also before that, we know also the taxes we incur are also part of our non-operating expenses. So let's look at the profit. I want you to think back from the time you started your business up to now. And we are going to go to the poll. Okay. From the time you started your business up to now, is it worth it doing the business? And if it is worth doing the business, why? Is it worth it? And then on chat, you tell us why it is worth it.
All right, so there you go. Our poll question is up. Think back from the time you started your business up to now. Is it worth it doing business? And like what we've done previously, we will take a minute, and we are 30 seconds away. All right, so I see the reasoning there. I've been able to save and pay my bills. Joseph, you're saying you make a profit. It is well paying. All right, thank you very much for those submissions. Serete, I've seen your question. We will address that. Okay. Okay, Grace, you're saying you haven't been able to make profit. So I'll bring this one to a close, and then I'll share the results. So there you have. 98% of us are saying yes, and 2% of us are saying no. Okay. So let me share the results, Esther.
Okay. Yes, Jimmy.
There you go.
Okay, thank you. Thank you very much for those results. As you can see, most of us are saying.
Sorry, Esther, I think you need to put the slides in a slideshow. We can see the notes.
Oh, okay.
Yeah.
Just a moment.
Okay.
Just give me. Sorry for that. So let's share.
Yeah, it's up.
It's up, eh?
Yes.
Okay. We are all clear, and we can see that most of us are saying that yes, it is worth doing this business. It's worth doing business, but also we have seen there are those who have said it, no, it is not worth doing the business. And we hope that by the end of this particular training, we'll know why probably how we should actually change so that it becomes worth doing the business. And with that, it's good to know, it's wonderful to see that you have been able to make much progress, and we are seeing the reasons why it is worth to do the business. So let us go ahead and formally define what profit is. When we are looking at profit, this is the money left over after you have paid all your expenses. You have your income, you deduct the expenses, then you are left with a profit. So as you are running the business, it is necessary to distinguish between the different types of profit. And also to know when you're making a profit and when you're making a loss. So have you ever imagined that you can have more than one measure of profit? Have you ever imagined that you can have more than one measure of profit? So far, we have just talked about profit. However, if you want to make better decisions, you need to be aware that there are three types of profits. And this is what we have. We have the gross profit. This is the profit that a company makes after you deduct the direct cost. So we have looked at what the direct costs are, and that is what is attributed to the production of the product or service. Then we have the operating profit. And this is the profit that the company makes after deducting its operating expenses. We are looking at the overheads that we saw, the selling, general, and administrative expenses. After that, there is the net profit. The net profit is the final profit that a company makes after you have deducted both the operating and non-operating costs. The net profit mostly is referred to as the bottom line. When you hear of company says, my bottom line is ABCD, we are talking about the net profit. And it is the true indicator of a company's profitability. And we can be able to summarize this in this format. Look at this. Here we have our profit and loss statement format. We have the sales, then you get the cost of sales, which is the production cost, and that is what we call the direct cost. You are able to get the gross profit after deducting that. Then we have our operating expenses, which are the overheads. After we deduct that, we get the operating profit. Then we have our non-operating expenses, the interest expenses, the taxes. No, the interest expenses, that is before we remove the taxes. We also get the loss from sale of assets and also the income that we get from sale of assets where we have made a profit. And here we are also now able to get the profit before tax. It is on this profit before tax that we calculate our tax. And after that, we get our net profit. By this time, we have deducted all our non-operating expenses, and we have added our non-operating income. So it is very important for us to understand this format and understand the profit and loss, because we are able to assess the success or failure of our business. What if you wanted to assess the financial strength? This has been able to give us the success or failure of the business. But what if we're asking ourselves, how strong is our business? The statement that is going to help us to do this is the balance sheet. And that is what we are going to look at next. So here, we are going to define what our balance sheet is and learn the importance of the balance sheet and eventually the format, just like we have done in the profit and loss statement. So a balance sheet, it is a statement that shows us the assets, liabilities, and capital of our business. It usually portrays the financial position of the business at a particular point in time. The profit and loss was over a period of time. Balance sheet is at a particular point in time. It shows you what you own, the assets, and how much you owe your vendors or your lenders, the liabilities, and what is left over after you get your assets, you minus the liabilities, it is known as the owner's equity or your capital. And we saw earlier that the profit and loss statement has three components. That is the income, the expenses, and the profit. The balance sheet also has three components. And we are going to continue and look at the treasures that we find in the balance sheet and what each of those treasures or the clues are going to lead us to. So we have the assets, which is equals to liabilities plus the owner's equity. And this is the way it adds up. For any asset that you have in your business, you either financed it using the owner's equity, or you borrowed money or borrowed from your vendors who gave you this on credit for you to acquire that asset. That is why assets in your business is equals to liabilities plus the owner's equity. Okay, so the balance sheet, it is a report that shows the financial position of the business at a particular point in time, like I said. So when you're looking at the balance sheet, many people tend to read that assets is equals to liabilities. And mostly they forget that the business is also indebted to the owner because you and the business are two different entities. So the balance sheet is going to show you what your equity is, what you own in the business, minus what has been financed by people from outside. That is your vendors and your lenders. So, and that is what is really left over. That is what you can say, this is what I am worth in this particular business. So let us look at your business assets. Assets, they are resources owned by the business. Therefore, the value of the asset at the time of reporting in the business, it is usually recorded at the original price. And not all company assets are usually recorded. You may find some assets like the brand. What you say here that the brand of my company is an asset, you'll not find that in the balance sheet. Or you find our assets, our human resources. The human resources will not be recorded in the balance sheet. So the balance sheet, for an item to be recorded as an asset, it must satisfy two conditions. They must have future economic benefit. And also, it is easy to determine the value of that asset. So assets, they're usually presented in the balance sheet in the order of which they can be converted into cash. You start with the most liquid, the ones which can be converted to cash very easily, and you move on to the ones that may take a bit of time. And now at this time, I would like us to list the assets we have in our business. On the chart, what are your assets? List some of the assets that your business owns. Let's go to chart.
Stock of goods, we have equipment, motor vehicle, all right, land, vehicle, printing machineries. All right, thank you very much for these submissions. Building, land, stock of goods. All right, so let me hand it over back to you, Esther.
Thank you, and thank you for the very fast response. Those are wonderful assets, and we use them to generate income for our business. The land, the equipment, we use it to generate income. And here you have randomly listed all our assets, all the way from stock to land to property. However, for the purpose of disclosing them in the balance sheet, we need to classify them into two distinct categories. And we are going to look at these categories of assets. We first of all start with the current assets. They consist of cash, goods for sale, and items having a short life. The current assets are what we call short-term assets. They're usually cash and other assets that are reasonably expected to be converted to cash very soon, within either the business cycle or within a period of not more than 1 year. So the business cycle, when we talk about it, it's the average time that is required to convert cash for inventory. You know, where you go, you bought inventory, you probably sold it onto debtors, and eventually they pay you cash. That is the business cycle. Assets, they're usually presented in the balance sheet in terms of their nearness to cash. How fast can we turn them into cash? So you will always find the current assets coming up fast. And now, if we look at our business, let's look at the current assets that we have. Those assets that we can easily turn into cash. And let's give some few examples of the current assets. What are the current assets in your business? In the chat box, just a few current assets. We listed all the assets. Now, which are the current assets in your business?
Inventory, stock. Thank you, Peter and Judith. We also have cash, laptop, ETR, stock, datas, okay, operating cash,
Wow.
datas, and the list goes on, checks. Thank you very much for that. Over to you, Esther.
Thank you. Those are great. And so the first thing that we have in terms of assets, we have cash and cash equivalents. Cash, we obviously know what it is. When you're talking of cash equivalents, we talk about the checks. We talk about the money orders, the bank overdrafts, the M-Pesa that you have, and any item that is accepted in the bank as deposit. Then we have short-term investments. These are mostly our marketable securities. We have certificates of deposits. We have the money market accounts that we have. We have the high yielding savings accounts that we have, the treasury bills. These are part of our short-term investments. We can turn them into cash within a short period. Then we have the prepaid expenses. Once you pay an expense in advance, that becomes an asset to you. You can correct goods on it because it's already paid for. Then we have accounts receivables, what our customers owe us, either individuals or organizations. Those are our accounts receivables. Then eventually we have stock. These are the items we have for sale, the products we have. And when you're looking at stock, if you're a manufacturing company, you start all the way from the raw materials that you have, the work in progress that is going on being manufactured in your business, and also the finished goods. All that make part of inventory. So from what you see, you can definitely identify with these assets because they are in your business. But that is not all. We are now going to look at the next classification. We have what we call the fixed assets. These are the assets which are purchased for long-term use, and they're not likely to be converted to cash very soon. And when we are talking of fixed assets, we are just talking about the long-term asset. These are assets that the business does not intend to convert into cash. They don't intend to just sell them as usual trading in the usual business cycle. The business usually employs its fixed assets to generate cash, and profits. And to add on to all this, let us now get examples of the fixed assets in your businesses. What are your fixed assets? You have them in the business, you employ them to generate cash and profit. Let's get a few examples of the fixed assets in your business.
So we have buildings, machines. Okay, Joyce says plant and machineries.
Wow.
Okay, land, vehicle, that's Judith, plant and equipments, tools, and the list goes on here, Esther. Over to you.
Thank you for that. So we can see, and thank you for all those responses. So we have plant, property, plant and equipment as you have given to us. So these are physical, they are tangible, they have a long life, and they will include all the buildings, the machinery, the land that you have, the office equipment, the furniture, that seat you're sitting on, the vehicles. They are grouped under property, plant, and equipment. Then we have what we call the intangible assets. These are not physical in nature. Mostly they'll be combined if you're able to quantify the goodwill, the brand recognition, the intellectual property that you may have. This we are talking about the patents, the trademarks, and the copyrights that you have in the business. Then we have long-term investments in the business. Are there some shares that you hold? They fall under the long-term investments because you do not intend to sell them within the year. Then on top of that, you have invested in real estate. That also comes under assets. So these are property consisting of land and buildings, and mostly you are using it to generate the non-operating income for the business. So what you find is that fixed assets, they're usually charged depreciation, or if it is the intangible asset, we usually call that amortization. And this is to recognize the wear and tear of the assets during the useful life. So far, you are able to assess the strength of your business in terms of your asset base. However, this is not complete. We need to go further to get the complete picture. So we need to look at the debt of the business. Failure to manage debt in the business can result to a loss in your business. Okay, you can end up losing your business because of the debt. And in that case, we'll go ahead and look at the liabilities in your business. And when we talk about liabilities, these are legally binding obligations that are payable to another person or entity. If you look at all your business assets, which you have listed, they are financed either by your investment into the business or external debts. You borrowed to acquire those assets. So the three essential characteristics of liabilities are going to include, there must be a duty or obligation to pay for you to call it a liability. And the duty is virtually unavoidable. You can't avoid it, you must pay it. The event of obligating the business has occurred. There is a time that you must pay that particular debt. So liabilities, they are listed on the balance sheet in order of their maturity. When do they mature? You start with the most current and you go on to the ones that will be paid back after a long time. So with that, let us identify some of your business obligations. Which debts do you have in your business? Which business obligations do you have? You used it to purchase your assets. What are your business debts? Let's give a few examples.
Okay, the one just in is creditors.
Yes, creditor.
Insurance covers, loans. Bernard says overdrafts.
Yeah.
Majority are saying loans. Peter says unpaid suppliers and loans. Bank loans, that's
Wow.
Charles Njoroge. Thank you very much, guys. So over
Thank
to
you.
you, Esther.
Thank you, Jimmy, and thank you for participating. And these are great contributions. So aside from listing your obligations, it is important to assign them to the required time frame. When are they supposed to be paid back? Okay. And the presentation of liabilities in the balance sheet, they will always be classified into two categories, just like we saw in assets. Okay. So we are going to have liabilities classified into two. We usually have current liabilities. These are liabilities that should be paid within 1 year of the balance sheet date. If it is 2021, those assets that must be cleared within 2021. They are payable within the business cycle or within a period of 12 months. Okay, and now, what are some of the examples of current liabilities in your business? Those ones that you should pay within this year. Look at 2021. Which are those debts that you must clear within the year?
Okay, so there's one here, bank overdrafts, suppliers, rent, bank loans, license, loans. Okay, this one I haven't specified which loans. Insurance, okay, borrowings, bank loan that is less than 1 year. Thank you, Sharon, for that.
Wow.
And of course, utilities, that's John. KRA, that's many taxes. All right. Yeah, sure. Thank you very much, guys.
Okay, thank you. Thank you very much for those particular responses. We have been able to see our current liabilities and we look at others. Accounts payable. This is what you owe your suppliers. They must be paid within the year. Then we have short-term borrowings. Short-term borrowings, we are talking of the overdrafts, like we have been told. We are talking of some of the notes that are supposed to be payable within this particular time. Those are our short-term borrowing. Then we have bills payable, the rent that you should pay within the year. I have heard somebody talking of insurance. If you took insurance and it is supposed to be paid in installment, mostly doesn't go beyond 1 year. So that is part of it. We have other payables like the interest, the taxes, the staff salaries. All that should be paid within the year. And what you realize, these are what we call our current liabilities. That loan that is supposed to be completed within this year, the whole amount that is remaining is actually a current liabilities or the installment that should be paid within this year. So after we have looked at our current liabilities, let us look at our long-term liabilities. And long-term liabilities, these are the financial obligations that for a company that are due in more than 1 year in future. They're not due in 2021, they'll be due probably from 2022, more than 1 year in future. And this is what we call the long-term liabilities. What I want you to note, the current portion of a long-term debt is usually listed separately to provide a more accurate figure of the company's liabilities. And that is where you find the current portion of the long-term debt will be under current assets. That is the installments that are due within the next 12 months. So, and for us to be able to really understand this better, let us list a few examples of our long-term liabilities. What liabilities, what debts do you have in your business that are payable within more than 1 year?
Okay,
What
so
kind
there's
of
one.
debts? Yes.
There's one saying long-term loan for over 1 year, bank loans, insurance. Benson says mortgage,
Yes.
debentures. That's Sharon. Thank you for that. Okay, Peter
Wow.
says he currently has none. Thank you for your submission.
Mhm.
So over to you, Esther.
Thank you for those responses. I can see we are all on the right track. So we have things like mortgages. You will not get mortgage for 1 year. Mortgages going from, those are long-term liabilities. We have bonds. If you have issued a bond as a company, then that is not payable within 1 year. That is also a long-term liability. We have notes payable that go beyond 1 year. That is a long-term liabilities. Then we have the leases, the lease obligations. That also is a long-term liability. So, and on top of that, just a moment, the lease obligations, as we go into the lease obligations, there are mostly usually two kinds of leases. You can have an operating lease or a capital lease. You find that a lease where eventually you are going to own that particular asset that you have leased, or by the time you are getting it, the value of the asset is over 90%, then you know that that is a capital lease that is part of your company. Then also we have the operating lease. The operating lease, you find it either being expensed in your P&L account, that is the profit and loss account, as an expense in the business, and that is also accounted for in a different way. So note, you can have an operating lease or a capital lease. Capital lease, eventually you will own the asset. Operating lease, what you realize is that a portion of each payment of the lease actually goes towards an expense in the P&L account. So that one will be recorded in the profit and loss, and for the capital lease, it will be recorded in the balance sheet. Okay, I just needed to clarify that so that you may not probably get surprised in terms of the way you account for various leases once you get a lease in your business. So, as we see so far, we have considered the business debts. We also looked at the assets. And now let's look at the other area. What is the owner's equity? We have looked at all these. Let's look at owner's equity. So the total resources invested and left in a business by the owner, that is what we call the owner's equity. It's the residual interest in the assets after you have paid all your liabilities. And the owner's equity or capital in the business is actually what mostly you hear being called shareholders' equity. The owner's equity, it's mostly made up of three parts. You have the ordinary shares, you have additional paid-in capital. This is primarily the excess of the amounts paid over the ordinary shares. Then you also have the retained earnings. After you have earned a profit in your business, the amount of money you plow back into the business goes towards being the owner's equity and the retained earnings. So the valuation of all your assets and liabilities, as we have listed them, okay, all of them, they are going to help you to measure the strength of your business. That is the assets, the liabilities. Once you have listed them, and eventually you are left with the owner's equity, what actually belongs to you in that business, then you get to know how strong is this business. Is it owned by debtors, or is it actually owned by the owner of the business, or you who is the shareholder? And so this is the format that we usually have. You have your assets, that's what you start with. You have your cash. You can see the way they are listed, from the most liquid to the least liquid. Cash, stocks, accounts receivables, then you have property, plant and equipment, and eventually you get your total assets. All these assets, they are usually financed by either the liabilities or the equity. That is where you have all your accounts payables, the bills payable, the long-term debt, then you have the capital and the retained earnings. That is the current and the long-term liabilities. And eventually, after you deduct this, you get the owner, you are able to get the owner's equity, which comes at the capital and retained earnings. The two sides, the total assets, then total liabilities and equity, they should balance. And that is what we call a balance sheet. And the reason why we are saying that it should balance, because any asset that you own within your business has been financed either by the current liabilities, the long-term liabilities, or the owner's equity. If you find that balance sheet is not balancing, then there is somewhere in our record keeping where we went wrong. And it is good to go and find out exactly what happened. After we have covered this, we have seen the balance sheet is going to show us the value of our company. But if you want to know about where all the money comes from and what it has been used for, we need another statement. And that statement is the cash flow statement. And that's what we are now going to look at. So a cash flow statement, it reports the inflows and the outflows of cash during an accounting period. And this report is going to show what activities generated money and what activities spent money during the course of this period. And what you should know is that the report provides very information about cash inflows and cash outflows. And this statement is going to show you how cash healthy is your business. And it is important for a business to be it is possible for a business to be profitable. And we saw that when we were looking at the business records. And yet you can suffer from cash crunch, which can disrupt your operations. And most of the time you hear business people wondering, where did the cash go? I am making a profit, but I don't have cash. So there are very many useful pieces of information that are hidden in this statement. The treasure hunt that we are doing, let's do our treasure hunt in the cash flow statement. So what determines the movement of cash in the business? The activities that you engage in on a daily basis are the ones that are going to determine that. And as we look at this, let's look at the business activities that are there. We have the business operations that go on. We have the financing operation, and we also have investment. So there are major three business activities. The operating activities, we talk about the buying and selling of the goods. Investing activities, we are talking about the purchase and sale of assets. That is the fixed assets within the business. And the financing activities, we are talking about the financial solutions. That is the adding of money or the repaying of loans in the business. Those are our financing decisions. So you, as the business, you are the key player in all this. You devise the strategy to achieve your business objective. You make decisions. So in the middle of the business operation, the investment decisions and the financing activities, you need to make decisions. So let us talk about this in greater details. So the key objective here is to look at the business decisions. I want you to go to the chart and let us write some of the business decisions that you make in your business. Which are these decisions that you make in your business? On a daily basis or even on a yearly basis, but every day we make decisions. Which ones are they? Let's take 2 minutes and we go to the chart.
Okay, so some of the business decisions that we make include decisions on some expenditures, decisions on what and when to buy, decisions around diversification of business operations. And let me take one last one here, decision on how much to spend on goods to sell, transport, and of course, salaries. All right, thank you very much. So I'll hand it over back to you, Esther.
Thank you. Thank you for those responses. We see the decisions that we make on a daily basis. The responsibility of decision making rests squarely on you as the business owner. If you're not able to make a decision, then the business will not move. As you make the decisions, you must factor in the cash implication based on the cash flow of your business. You can only draw from an available pool of cash. And if you don't have cash, then making those decisions becomes difficult. I want you to look at this. Look at this pool of water. The water flows in through a narrow at the top. There is also water draining out from a narrow at the bottom. So cash flow is like a pool of water. It's like this pool. And let me ask you, when we say that cash flow is like this pool, what do we mean? We have a pool here. There is water that is flowing in and water that is flowing out. Why is cash flow like a pool? Just give a few suggestions on the chart.
Okay, let's see what we have. Cash is like the water, right? That's the rate. The pool is your business. Thank you, Lorna, for that. All right, let's see what else we have. Because money comes in and money goes out, that explains why cash flow is like water. Thank you for that. If it dries, then it cannot flow. That's Huntington.
Wow.
Okay, let me take one last one. Water in and out is cash in and cash out. Thank you very much for that. So over to you, Esther.
Wow, I am amazed. Those are amazing answers that if it dries out, then it cannot flow. You have money coming in and money going out of business. You need more cash flowing in than cash flowing out to keep the pool of cash in your business. That is one of the things that we really should take into consideration. But if we find that the cash flowing in is less than the cash flowing out, then we have a very unhealthy business. So a business is considered healthy if its cash inflow surpasses the cash outflows. And now with that, we need to ask ourselves, how is cash flow different from profit? How is cash flow different from profit? So what you see, profit is not exactly the same as cash flow. A cash flow will represent the amount of cash in a business at a given time, like what we see in this picture. This is the water that we see in the pool, the excess cash. Profit, it is revenues minus expenses. This is what is reflected in the profit and loss account. And now, let us attempt an example. Okay, we recall an example of the money in your business for the last 6 months. Let's look at this. If you look at your business in the last 6 months, give us examples of cash inflows and also examples of cash outflows. Where did money come in from and where did the money go? Look into your business, the last 6 months, what were the cash inflows and what were the cash outflows? We have 1.5 minutes.
Cash inflows include sales, purchased products and services are inflows. Hassan says sales are inflows. Okay, customer sales are inflows. All right. Disposal of assets is an inflow. Outflows are expenses, employee payments, invoices paid, and suppliers we paid are outflows. Thank you very much for that. Over to you, Esther.
Thank you for those responses. So already we can see cash flowing in and out of a business. And we should always be aware of when cash is flowing in and out of the business. We need to pay attention to that for your business to ensure there is always cash available for operations. And cash inflows must exceed cash outflows. That is what we need to look at. And now as we look at the cash flow statement, there are usually 3 cash flow boxes that we have and that are very variable. We have the operating activities, so we have investing activities and we have financing activities. This is where our cash flow will operate from. In operating activities, these are usually connected to the manufacture and sale of goods and services in our business. The cash inflow from operating activities will include the cash sales or the correction of credit sales that we have done. The cash outflows from operating activities will include the cash we have paid for raw materials or merchandise, the payments for accounts payable, where we had purchased goods on credit, and also the cash paid for salaries and wages. When we go to the investing activities, these include the result of the purchase and sale of either debt or assets within our company. That is the fixed assets. So the cash inflows, they are going to come from the receipt of sale of equity or debt facilities, where we sell assets, where we get debt. This is what we are going to get from the investing activities. Then we have got cash that we receive from the debt securities. Either there is interest that we are paying or interest that we are paying out, then that will go under the cash outflows. When you pay for assets, the cash is flowing out. When you pay for various debts, when you pay debts that are there in your business, cash is flowing out. So in that particular case, we see the cash from investing activities. Then let us go to the financing activities. In the financing activities, where do you get money to invest into your business? This is where, for any shares that you sell, the dividends that you get, the loans that you get, the repayment of the loans, these are your financing activities. And cash inflows from financing activities, they will comprise of funds that you raise from the sale of shares and funds that you get in terms of loan. Once you get a loan, it comes under the financing activities. And cash outflows will come when you are repaying a debt. At the financing activities, when you are repaying a debt, and then probably one of your partners decides that they want to sell back their shares. Once you repurchase those shares, this is also a cash outflow under the financing activities. And if you pay dividends for any shares that is issued, then those are cash outflows that come from financing activities. So in this, we get our 3 treasure boxes that we have. That is the operating activities, the issue operating of the business, investing activities, the sale or purchase of assets, fixed assets, and financing activities, the loans we borrow or the shares that we purchase or buy into our business. And this is the format of the cash flow. And we can see the way it's usually presented. You start with the operating activities. Then eventually you get the cash sales, the cash collection from customers, payment of credit, the cash paid for raw materials, payment to vendors, and eventually you get your operating, the net cash from operating activities. So what you need to note is that in line number F, as you can see, it is going to show the net cash flow from operating activities. Then we go at the investing activities, the cash received from sale of shares, the cash received from sale of debt equity, the cash you receive from sale of fixed assets, the purchase of equity, that is the purchase of assets. Then you get net cash from investing activities. So this is what you get from the investing activities that you may have in your business. So when you go to the line number M, you get the net cash flow from investing activities. And then line V, the line V that you get the net cash flows from financing activities. So this statement, it is going to help us to see the potential cash problems that we have. A negative cash flow from operating activities is a big red flag. That the business is not generating cash. You're not generating cash from the core businesses, the core goal of the business. If you have a negative cash flow from operating activities, so you need to become very aware of that. And if you're not generating cash, where will you get it from? Will you get it from investing activities or from financing activities? We need to prepare for that. And it is at this time that you decide, when do I borrow a loan? So at a remedy measure, you can just find yourself to organizing for a short-term loan facility. That can be a stopgap measure for that particular time. A negative cash flow in investing activities can also be a cause of a problem, because your investment should be profitable. It should be bringing more cash. Are you buying shares in companies that are not giving you returns? That is what you should be asking yourself. Then you should ask yourself, do I really need to invest in those areas? Have I been buying probably boats that are not bringing returns? Then negative cash flow in financing activity is also a cause of concern. You need to investigate the cash outflows exceeding the cash inflows. Are you paying too much interest? It may as well be, as a business owner, you're probably picking a lot of money from your business. You are withdrawing too much from your business. When you see your financing activities, you are having a negative cash flow. And it is at this point you decide you need to put a fixed monthly salary for yourself, so that you stop raiding the cash box or the bank account for your personal use at all times. That is going to help you in that particular issue, so that you're able to survive on the salary that the business pays you. So from all this, it's clear that each of the financial statements plays a special role in helping you manage your business. And the key thing to remember is that financial statements can be presented in different formats that we have been able to see all through. And your needs as the business owner are very different from the needs of stakeholders outside the business. And because of that, we need to classify the accounting information. Our information in accounting can either be in terms of financial accounting or management accounting. Financial accounting, it is designed for your business stakeholders. the ones who interact with your business outside the business. These mostly, they are the investors, your staff, your suppliers, your bankers. For them, they want the financial accounting. And the financial statement, therefore, this is where you are asked for audited financial statement. Other financial accounting, they are interacting with outsiders. Then we also have accounts that are represented under management accounting. That is the management accounting information. They are designed to support the management team in making decisions, and they are related to business operations. They use information to identify targets, devise plans, and manage daily business operations. And they assess the performance of the department or the individual. So this is what you use when you want to make internal decisions. So as we learn more about this statement, I want us to look at them a little bit deeply. So the management accounts, they provide financial and non-financial decision-making information. They'll be combined with financial and non-financial. They give you some reasons. You're going to be able to analyze, to interpret, and to identify information that managers can use within their business. The key objective of management accounting is to produce useful information for internal use, for you to use in the business. The business owners, you are able to correct information that are going to encourage you in strategic planning. They help you in setting realistic goals, and they encourage you in efficient directing of the company resources. And that is why we say that you will always be told, even by a bank, if you don't have the financial info, you have not audited your accounts, can we get some management information? These are just what you have been using within the company. And management accounting, it's forward-looking, and it takes past performance of the business to create the forecast for the business, to show you where you're going. And now, as we look at this, in terms of your business, which information in your financial statement, would management be least be interested in? We have looked at the 3 financial statements. Which one would management be least interested in? And we are going to go into a poll that we are going to take 2 minutes to go through. Jimmy, please take us to the poll.
All right, so in a minute, and we are asking, which information in your financial statement would management be interested in? There you go. So the same drill we use will be up for 1 minute.
Sorry, which financial information in your statement would management be interested in? Yes, not least interested in, interested in. Thank you. Let's go to the poll.
So we are 30 seconds away. Francis, I see you're sending something on the chat. Thank you for that. Okay, and those who are asking for the recording, it will be shared to you. Be sure for that. Okay, so we are 10 seconds away, and then we'll bring this one to a close. Okay, so there we go. Let me share the results.
Wow,
so which information in your financial statement would management be interested in? 25% of us are saying profit per product, 6% are saying cost per department, and then 21% of us are saying cost comparison between actual and budget. Okay, and then 36% and 12% of us are saying cash ability for paying business running costs and accounts are edited respectively. So there you go, Esther. how it looks.
Thank you. Thank you very much. We can see most of the people we are looking at, from whatever we see that the management, it's more interested in internal information. And that is why probably most people wonder, why do I have to prepare the audited? Because for us, we're interested in the internal information. The accounts are presented in different formats and level of detail to make sure better decisions are made. As the business owner, you determine what kind of information you have. So we have looked at this. We see what management is interested in. What about the persons outside the organization? They are looking for financial accounting. And in financial accounting, you find the summary, the analysis, and reporting of financial transactions, yes, related to a business. The financial accounts, these are also referred to as the audited accounts. They are going to disclose the business performance and also the financial health. The financial account is prepared for external users in mind. The information created in this accounting, in financial accounting, it's entirely historical. And let's see the kind of information the people external to the business would be interested in. We have seen what we would be interested in as business owners. What information would the people external to our business, what would they be interested in? And we are saying, okay. And the question for this is, which information in your financial statement would outsiders be least interested in? In this case, it's least interested in. And we'll go to the poll. No, this one we are going to the chat box.
Chat box.
Yes, to the chat box. What would you be least interested in? We have it in the financial statement. Okay, are we getting some answers in the chat box?
There's a balance sheet, cash flow, okay, petty cash books. Okay, balance sheet, yeah, investment. Thank you for that. That's what we are getting, Esther.
Okay, thank you. So things like the petty cash, your outsiders are not interested in that. So we see our outsiders, they are more interested in highly summarized audited accounts. Some of you put that what they're interested in, we need a balance sheet, we need the cash flow and all that. So let us differentiate between these two accounts, these two financial accounts. What we find is that management accounting, it's for internal users. Financial accounting is for external users. Management accounting, it's for current and future data, while historical data is what we look at the financial accounting. The reporting formats at the management accounting, they're usually adapted to suit the management needs. While when we get to the financial accounting, the reporting format is legally regulated. We are guided on how to do those accounts. Then in management accounts, they are highly detailed. This is where you get the price per product, the cost per product and all that. While in financial accounting, they are highly summarized. We just want to know the sales and the purchases. The reports in management accounting may show even per product, per region, per department, and customer segment. While in financial accounting, the reports are just for the entire business. Management accounting, we focus on identifying the problems and fixing them. And in financial accounting, we are not able to identify the problems. And therefore, we are not so focused about fixing them, therefore external users. So with all this, we see where we are. We are looking at efficiency in management accounting. So let us now go to the point where we are going to conclude our course. We have covered quite a number of items, and by now, we should be able to describe the key financial statement, to explain the importance of financial statement, and explain the format of the financial statement. We have covered all of them, from the definition to the importance and also to the format. So we can conclude this course. And for us, it is important to now go to the area of application. So reflect on all that we have learned in this course. And after reflecting, ask yourself, which are the 2 new ideas that after you come up from here, you're going to implement? Share with us in the chat what you're going to implement, just 2 new ideas that you're going to implement in your business from what we have learned today. Let's take 2 minutes.
Okay, so Boniface says he's going to reduce cash outflows. Another one says setting up monthly salary. Is going to shift the focus to management accounting. Another one is going to do proper monitoring of cash flows. That's Oscar. Thank you very much. Lorna, you're saying you're going to be noting all the inflows and outflows and develop the statements. Thank you for that. Fixing salary for myself. That's management accounting. Thank you very much. Your comments are coming in very fast here. Let me take one last one and hand it over to you, Esther. I will take creditor management more seriously as it affects cash flows. Thank you very much for all your comments. I can see they're coming here. So over to you, Esther.
Thank you. Thank you for those responses. So what I urge you, implement and practice the ideas that you have learned and the one that you have picked out, so that we can have better use of the financial statement. Now from here, we are going to look at the courses that we are going to be covering in these financial literacy webinars, and to urge you for you to join us. We have understood the financial statement. Next week, we'll be covering a topic on how to use the financial statement. After understanding them, how do you use? We have seen cash flow is very important, so we are going to have a topic on cash flow management. We will also have a topic on working capital management. This is where you actually become the heartbeat of the business. Then also on top of that, we'll do the loan management in the weeks to come, and we'll close off with the savings and investment for how we do. So what I urge you, continue joining us in this particular training on Thursdays from 11 to 12:30, and set your action plans to be able to implement the new ideas. And of course, keep watching out for the next course, which is using financial statement. And with that, we complete the course. There is an evaluation that Jimmy is going to share with us on the poll, I believe. And with that also, we go back to the Q&A for any question that has not been answered. So let's take part in the evaluation.
So thank you very much, Esther. And as we take through the evaluation, I'll hand it over to Peter to take us through some information on his side on Cooperative Bank. So Peter, if you can hear me, the floor is yours.
Yes, I can hear you, and thank you so much. As we conclude on this, we really want to appreciate Esther for that great presentation. I think was quite informative, Esther. We really appreciate, and looking at the comments, we actually appreciate the trainings, and I can see most of us have indicated their next steps in terms of what we want to go and start implementing. I know time has really moved, and I know there'll be one or two questions that we want to answer, and we have answered more than almost 100 questions through the Q&A and also through the chat box. I really appreciate that engagement that we have had. We may not be able to go through the whole presentation on some of the solutions that are related to what Esther have just trained us, encouraging us to understand the financial statements and see how do you look at them and work on the cash flows that are very much needed in our business. So I know we have MSME solutions that we've talked about in the past on the accounts, the bronze, the silver, and the gold packages. The accounts that are for business people. We will continue to talk more about them in the near future. But they support us in regards to what Esther have just trained us, in regards to cash flows, in regards to financial statements, in regards to assets for our businesses, and they are part of the liabilities that possibly we have been talking about. And I looked at one of the questions that had been asked by one of the customer or a participant, and she was asking, how do I ensure that I'm able to grow my cash flows without even adding a lot of costs? And one of the things I indicated is that one of the ways that we want to take is to continue marketing even online and getting to have the data of our customers, so that then we can continue to add the sales, which is also very key in terms of working on the profitability. So I think without going back to the presentation, is just to say that we have those solutions that also support us on our cash flows, ensuring that we have enough assets that will also drive our cash flows. So we have those working capital facilities, we have asset loans, maybe to support on mobility, purchasing of vehicles or motor vehicles that are also key in growing our business, and also earning the assets that is also very needed in our business. So we'll continue to share more information in regards to these solutions. Of course, we have the e-credit or the mobile loans that continue to support us. I was looking at the current liabilities, and one of the loans that we have that support us to do business, which we can categorize as a current liability, is the mobile loans, because it goes up to 6 months, and the limit is up to 1 million. And you can see how then you can also qualify for this, just to ensure that then you have cash flows, you have some payment solutions, or you're collecting your your incomes and your sales, and you are at a good position to qualify for these facilities. And we will continue to support you just to ensure that you are well facilitated in this. There's the credit guarantee scheme. This is a solution that is very new to us and to our customers, that we have partnered with the government of Kenya to support us on a solution that will continue to support us grow our business, and especially at this time of COVID. Just ensure that your business is registered, your county government has given you a business permit or a trade license, and you have registered as a taxpayer with the relevant tax laws. So have that compliance certificate, because you are able to get a loan with this bank that has an interest rate of up to 12.5%. I think this is a very affordable loan that again will support you to ensure that then you have cash flows in your business. We have limits there, as you can see, of 1,000 to up to 5 million. And the tenor or the duration for this is 36 months. So this is also, again, the loan purpose is to ensure that then you have working capital needs, you have stocks, and you're able to acquire new assets for your business. So it has those benefits. As I indicated, the percentage is very competitive. You can be able to take advantage of this. And it's quite fast in terms of getting a decision. You get a decision within 24 hours. And you can actually have this facility and they land concurrently with another solution. And the other thing is they're very flexible. We're able to support you with both secured and unsecured facilities. Because of time, Jimmy and Esther and the participants, we want to leave it at that in terms of the solutions that we have and we wanted to share in addition to what we've just gone through. But those are our contacts, and we are also available in our branches. The branch managers and the relationship managers down there can support you with more information in regards to this, and we remain committed to support you with all these solutions. So I want to stop at this point, Jimmy, and we'll continue to have further engagements in the near future. Thank you so much.
Thank you very much, Peter, for that presentation. It has spoken to some of the questions that I was to pose from the participants, which has been answered, especially on the benefits and part of the loans. So I would like to bring this session to an end. But before that, I'd like to thank each and every one of you for taking time out of your very busy schedule to come and join us today on our second session. Today we've learned understanding financial statements. And it is our hope that we've been able to speak to your expectations that you have been able to share with us in the beginning when we started the session. I'd like also to thank Esther for such a great presentation, and I can see the feedback there. Thank you very much for that. Thank you, Peter, for putting all this together from your core bank side. And our colleagues online, Winnie and Gideon, who have been extremely busy trying to answer all the questions that you've put on the Q&A. So until next time, I'd like to thank everyone and all the best in your businesses. Thank you very much and goodbye for now.
Thank you, Jimmy, and goodbye to all of us.
Thank you, Peter.
Thank you.